Convertible notes: how to prevent death spirals in funding. Imagine raising money for your startup and suddenly facing a situation where your company's stock price keeps falling and your investors keep converting their debt into shares at lower prices. This can cause your ownership to shrink rapidly, making it harder to grow and attract future investors. This tricky cycle is called a death spiral, and it can be a real threat in early-stage funding. Convertible notes are popular because they let startups raise money quickly without setting a valuation right away. But if not set up carefully, they can lead to a death spiral. The main issue is when the conversion terms encourage investors to convert debt into shares at prices that drop as the stock price falls. This causes more dilution and makes the stock price fall even further, creating a vicious cycle. To avoid this, founders should set a fixed or minimum conversion price instead of a variable one tied directly to the market price. This means investors can't benefit from pushing the stock price down to get more shares at a cheaper rate. Including a cap on the total number of shares that can be converted also helps prevent excessive dilution. This cap limits how much ownership can be transferred to investors, protecting existing shareholders. Another key point is to avoid or limit discount rates that decrease as the stock price drops. These discounts can tempt investors to short sell the stock and convert at lower prices, fueling the death spiral. Restricting short selling by note holders can also help prevent downward pressure on the stock. Using valuation caps and clear maturity dates in the convertible note agreement adds transparency. Valuation caps set a maximum company valuation for conversion, giving investors confidence and reducing aggressive tactics. Clear maturity dates specify when the notes must convert or be repaid, avoiding indefinite extensions that can worsen the situation. Some founders consider alternative funding options like priced equity rounds or simple agreement for future equity notes without complex conversion features. These options carry less risk of triggering a death spiral. Maintaining open communication with investors is essential. Explaining how the convertible notes work and monitoring their impact on stock price and ownership helps keep everyone aligned. Working with experienced legal and financial advisors ensures the agreements are balanced, protecting the company from dilution and manipulation. Understanding these mechanics is vital because a death spiral can erode ownership, hurt your company's valuation, and scare off future investors. Properly designed convertible notes help keep your funding stable, protect your ownership, and build investor confidence as you grow your startup.